Enterprise value is one of the most complex concepts in the industry. Not many theory books explain very well what really is enterprise value. First, it is the value of all the operating activities of a company. But what are operating activities? Operating activities are all the activities that the company is doing as a primary activity. For example, Apple selling hardware and software, Facebook being a social network, and so on. It is the value you get from the discounted cash flow model when you discount all the cash flows. Enterprise value is generally used as a comparable metric. Later we will see how. For listed companies, the formula to compute enterprise value is the sum of equity value, so market cap, plus dilution, stock options in the company, all debt, including financial leases, operating leases, as per the latest IFRS guidelines, plus convertible bonds, pension deficit, and minorities. From this sum, you will need to deduct cash, cash equivalents, associate, and other non-core assets. For example, Apple owns 100 million worth of real estate in London, but not for its stores. This will be non-core. Let's go into the details of the most complex items. Operating leases. They became a problem in 2020, when IFRS, accounting standards, required to consider operating leases, in practice rent, as an equivalent of interest plus depreciation. This means that on the balance sheet I will need to recognize a debt obligation paired with a right-of-use asset of equal amount. In the income statement, I will then recognize depreciation and interest instead of rent in the previous standards. Accountants will compute the right-of-use asset and the debt-like obligation. You can find the value of the debt obligation on the balance sheet. Let's look at minorities. Company A owns more than 50% but less than 100% of Company B. As per accounting standards, I need to consolidate 100% of Company B, but the equity value of Company A only reflects the real ownership, which is less than 100%. In order to give investors the true representation of the value of Company A, I will need to fill the gap, including the remaining portion of equity of B I don't actually own. Generally, you will find the value of minorities on the balance sheet. Pension deficit. Over the years, Company A put aside money to pay for retirement of its employees, but in case the value of the asset, so money Company A put aside, is lower than the value of liabilities, what Company A needs to pay for retirement, Company A has to consider this delta as a debt-like item. Again, you can find this item on the balance sheet. Associate. Company A owns less than 50% of Company B. As per accounting standards, numbers are not consolidated. This means that this investment in Company B is non-core, thus you will need to deduct this value from the formula of the enterprise value. You are deducting this value because the equity value of Company A always includes the real ownership and so also the value of the associate, even if it's something non-core. Again, you can generally find this value on the balance sheet.